right, so let's dive into the volatility risk reversal trade. The VIX is what we're going to be using for this type of trade, and it really combines two different option strategies. And again, we've talked about risk reversals. This approach can be applied to other. Doesn't have to be built around volatility. It can be applied to any optionable security. So you can do this with optionable stocks, index products, ETFs. Uh, but there's a key component to it that I think is very powerful when applied to the VIX itself, because the VIX is really one of the few true mean reverting products out there. So it it is bounded. It does mean revert to a static price level. Generally when we talk about mean reversion with like a stock or an index, right? Those are generally will go up over the long term. Like if you look at the S&Ps or the Nasdaq, right? They'll generally over the long term go up, and so your average or your mean is also over the long term increasing. So when you mean revert, you're mean reverting to often to a much higher price level. Whereas the VIX that's not the case. It's not like 10 years down the road, we're going to, on the VIX, when we mean revert, we're going to mean reverting to the 50 level or the 75 level or the 100 level, right? So the VIX does have static horizontal price level mean reversion. And so what's cool about that is, and I'll compare this to like a stock. So, if you, just take we'll just use generic like ABC stock, right? Um, so ideally, obviously, if it's a good company and uh, the stock will go up over the long term, and hopefully not go down to zero. But there are stocks that go to zero and get delisted, and right, it happens. Um, so we'll first start. Because again, this is two option strategies combined. We'll first start talking about, uh, and it involves both the call side and the put side of the option chain. Well, let's start on the put side. So selling put premium. So if you sell put premium, and again, you could do this on any optionable stock, right? There's a degree of risk there, and that risk really is obviously it's highly correlated to your position size, your exposure. Um, but the so that's more of a subjective risk. The objective risk is the stock going down to zero, right? So if you sell put premium, we'll just use since we're on the VIX chart, we'll just use this as a theoretical or hypothetical price interval, right? So but we'll actually say this is zero, right? So if you are selling put premium, let's say you sell a 40 put or a 45 put or a 47.50 put, right? And all of a sudden the stock tanks, and let's say and it drops below any of these strike price levels, or it even goes to zero. Okay. Then that as a put seller, right? That's bad. You don't want that to happen. And again, it does unfortunately happen. The stocks go to zero, they get delisted. The put seller is out of luck, right? They've lost a lot of money, and that stock, if it's been delisted, is not going to go back up. Right? And there are plenty of examples of other stocks that are trading at higher price levels that go down and never recover. Again, as long as it's a quality name, eventually, the company stays in business and does well. It likely will, but this is a risk of selling put premium on individual names, individual stocks. So, what about selling put premium on the VIX? Well, the VIX can't go to zero. The VIX is always going to go back up because the VIX is a volatility product. So volatility is always in contraction or expansion. So when we're in expansion, the VIX goes up, and when we're in contraction, the VIX goes down. And it's just constantly doing this and tends to form pretty, well-defined. Again, this is going back to mean reversion. It mean reverts to an actual static horizontal price level. You can go, we can go back, just let's go back 10 years on the VIX. Right. So you can get a pretty good picture here of extreme low levels on the VIX that without fail eventually recover. Okay, so again, this is volatility, contraction, and expansion. We've talked a lot about that. So selling put premium on the VIX is as far as put selling goes, is a relatively low risk approach. Because you can manage this in different ways. That's one of which we'll talk about in terms of an adjustment that correlates to this strategy. But when you get volatility expansions, right, that benefits your short put position. Okay, so we'll talk about that. But that's kind of the basis for the understanding of this, um, and where we start. So let me first go back. Okay. All right. So if we hop over to the options chain here, and in fact, I've got a position, call debit spread position on the Jan 22 expiration currently, so we can actually use this. Um, but let's just go out to this expiration. Um, so when we talk about selling put premium, okay, if we sell an at the money or out of the money put on the VIX, right, we collect a credit for doing so. So again, on today's close, VIX is at 1587. If we go one strike out of the money, uh, these puts are bid at 82, offered at 94. And by if just be aware, we're after market hours, so some of the DAS spreads can get a little wonky here, but um, nevertheless, the one strike out of the money put premium. Okay, if we sell put premium here, okay, so sell and put, right? We collect a credit, so we can just use the midpoint to get kind of an idea of where that would be. So it's 12 points, add six, so about $88 a contract at the mid. Uh, is what we would collect. Okay. So we could do this as a standalone strategy. We could just sell put premium on the VIX. And the idea, of course, is for the VIX to remain above that strike price by the expiration date to retain that premium or credit that we collect into the account for putting that trade on. Now, again, going back to just the general idea of selling put premium, the risk here is if the underlying drops below your strike price, right? That's going to cause the premium to increase, which results in a floating loss to the put seller. And the put seller wants the underlying to stay above the strike price for the premium to decay and to retain that credit. Well, when VIX is down at low levels, that can be quite easy to do. And I'm always hesitant to use the word easy as it relates to anything trading wise, but uh, it's a rather simple trade that, when done correctly, can be quite consistent. And we'll get into adjustments here momentarily, but is easily adjustable as well. So rule number one is we want to look at selling put premium when the VIX is low. And so what do I mean by low? Well, we just looked at a 10-year chart of the VIX, right? It's unusual for it to get down, much below 13, 11, somewhere in that range. Um, so it is a bit higher now, and so it currently at the current VIX levels, I may not be so inclined to sell put premium. Might want to wait for it to come down. But when VIX was down, around 13, and at that point these put contracts would have been trading much closer to the price of these 1550s and slightly higher depending on how far out in expiration we are. Um, okay, that would be an ideal time. So my rule of thumb is when VIX is below 15. So kind of somewhere in this 11 to 15 range is suitable for me to sell put premium on the VIX. Okay, the lower the better, but as long as we're below 15 on the VIX, okay, it's a viable range for me to sell put premium. So by doing that, collect a credit or deposit into my account for selling that put premium. Okay, so what are my options? Well, I could just keep that put premium, hang on to it, and ideally the VIX will close. Because remember, and this is another powerful kind of feature of the VIX as it relates to put selling. If and again, if's not the right word, when the VIX spikes, it always comes back down. Okay, it's just I look at the VIX as a matter of time. Okay, the VIX to me is just a matter of time. It's a matter of time for it to spike. It's a matter of time for it to go back down. But it will do both, and it will alternate between increases, decreases. Okay, because remember, the VIX is really one of the few true mean reverting products as it relates to horizontal price levels. So when the VIX is low, even if we get a spike, I know it's going to come back down. So this is kind of the range that I like to use to sell put premium on the VIX. So going back to what could I do with that? Well, I can just keep it, and ideally the VIX closes, above my strike price, and I retain that premium. But it might come back down below, and that's why I want to make sure VIX is already down at low levels when I execute this strategy. And this is where we'll get into adjustments, but I can, if for some reason the VIX drops back below my strike price, like let's say I sell 15, or let's just go with 1550. Let's say I sell 1550 strike puts on the VIX. Okay. Well, what if over the course of the next 35 days, or at least by January 22nd, the expiration, the VIX drops back below 1550? Well, I'll have a floating loss in the position, but I know eventually the VIX is going to go back up above 1550. It's just a matter of time. So again, we'll get into this more in depth in just a minute, but I can roll these contracts out, so further out in expiration, and ideally do that for an equal or greater credit, and just wait for the VIX to spike. Okay. So there's a couple things you got to be careful of. You got to be careful of things like backwardation and whatnot. But this is generally feasible, and I could just do that as a standalone strategy. But what else could I do? Well, I could take this $88 credit, and I could go out and buy a call debit spread. So what does a call debit spread do for me? Well, if the VIX spikes, I can make money on the call debit spread. So I can do an out of the money call debit spread. And as I mentioned, I've actually got a position on here, as you can see, at the long the 20 strike calls and short the 30 strike calls. So I've got a 10-point wide spread on here. And if the VIX spikes up into the range of the spread or beyond, this call debit spread can potentially make a lot of money. Oops, didn't mean to hit that. All right, so what if the VIX doesn't spike by January 22nd? What if it just stays at current levels? Or maybe it just goes up a little, right? Because currently, if I were, for instance, to sell the 1550 strike puts, I've got $4.50 of distance in between my call spread and these short puts. So what if the VIX trades up around in this area. Well, then, over the next 35 days. Well, then I'm not going to make any money on my 20/30 call spread. But I'll watch these 15/50 strike puts decay, which will allow me to capture the premium. And I can just tell you what I paid for this 20/30 call spread. I paid 70 cents. So $70 a contract I paid for this call spread that I have on right now. So what does that mean? Well, if the VIX stays, let's say, between 1550 and 20 over the next 35 days, I won't be able to close this for a credit, most likely. I mean, potentially, if we get a more of a near-term spike in the VIX, yeah, I could, my call spread will probably have some profit potential. But using the Jan 22 expiration, in VIX below 20 would see those contracts expire worthless. However, if the VIX remains in this range here, I can capture some or all of this premium, at least a good portion of it, and finance the cost of my call spread. So this is called, we call it a risk reversal. So, and again, it can be done on individual stocks, but it's essentially selling put premium to finance the purchase of call premium. So that could be a single leg call. It could be a call debit spread, like in this case. And generally, I don't generally buy single leg calls on the VIX. I set up spreads to take advantage of the vol skew. Okay, so looking at implied volatilities, this is something I won't get into right now in much depth, but we've talked about this a lot in the past. But I'm buying the lower implied volatility, selling the higher implied volatility. Okay. So taking advantage of the vol skew, that's why I do the call spread on the VIX. And number one, it lowers the cost of the trade for me, right? To allow me to sell a single leg put to finance the purchase of that call spread. So this, just to kind of sum up, increases my potential positive outcomes. If I only do the call spread and I don't get a sufficient VIX spike, I could lose my 70 cents. Okay. If I only write puts on the VIX, out of the money puts on the VIX, okay, my max profit potential is the credit that I received. And if the VIX spikes way up, that's good. I get to retain some or all the credit from the put premium, but I don't really have my reward is capped. I can't make more than the premium I collected for writing the puts. Whereas with the call spread, I have significant upside profit potential. So I'm combining kind of the best of both worlds that if, and again, I shouldn't be using the word if, when we get a VIX spike, I can make money on the call side and the put side. But if for any reason volatility remains low, I can set this trade up so I have, whereas if I only put on a call spread, right, at 70 cents, if VIX closes at expiration below 20, I lose the whole 70 cents. I could actually potentially make a net profit if we don't get a VIX spike. I could potentially mitigate the risk in my call spread. That's 70 cents. So this is where the risk reversal gives us more potential positive outcomes.